In this video, I'm going to show and tell you the mistakes I've made as I started my investing journey with Freetrade with my dividend growth portfolio. I'm also going to be talking about related news too, so stay tuned. Firstly, in recent news, Freetrade has started crowdfunding again using Cked. And in fact, they've seen a lot of success with it. They've managed to raise a capital of 5 million on their crowdfunding site. So we can certainly confirm the longevity of this platform if they are consistently getting high crowdfunding numbers, and so long as the demand remains high. And there's still 28 days to go left. More about the markets. We've seen a substantial sell-off in the markets over the last few days and the whole week. And it was doing quite well up until Wednesday, and then it just plummeted, but now it's started to rally again. So I do want to show you my portfolio and how it's performed against the market. And I believe the market drop was the investors pricing in the reopening of the economy and subsequently a potential second wave of pandemic cases due to an easing of the lockdown across the world. However, Friday has seen a lot of these companies rallying back. So perhaps I'm wrong, and perhaps it was just a blip due to unemployment figures. So this could potentially be a downtrend. But one thing we do know is that a large amount of volatility will likely happen in the coming weeks. So how has my dividend growth portfolio with the Freetrade UK app performed this week? We're currently down by £180, which I'm happy with because I've certainly seen other portfolios dip further. But it isn't about comparing me to other portfolios. It's the fact that as a whole, the market dropped a lot, and I feel that the portfolio I have has regained a lot in that time. I've also passed the ex-dividend date for Unilever and Shell, which was the 14th. So that is a dividend I've earned, not necessarily been paid yet, but it is on the way. That waiting with BP and Legal & General for their dividend payments too, so not long now. I've actually slightly altered my investment method, and in fact, I've bumped up my allocation with Redrow to my highest position because this is the company I'm probably the most bullish on. And I believe it presents one of the higher risk/reward ratios, and that's definitely shown by its high beta volatility. I've continued to average down on Shell, Aviva, and Legal & General too, which are currently some great buying opportunities. I think Redrow has kind of lost that buying opportunity, but those three companies are certainly a good thing to look at the very least. Rio Tinto, National Grid, Diageo, Sage, Unilever are doing okay. I mean, I haven't really expected much more of them. They're kind of just holding their value for the time being, which is fine, seeing as I haven't held them that long. But interestingly, one of my more defensive stocks, Britvic, has seen quite a large drop, and I'm a bit confused by it. It's quite interesting to me because I thought it would be similar to Unilever and Diageo, where they would only drop small amounts, but it seems like it has high volatility. Friday alone, it dropped by 6%. So if you know why this is happening, please leave a comment down below and explain why. Thank you. I've also completely used up my cash position, and now I'm sitting at 99.5% in stocks. And now I'm going to be very dependent on weekly deposits. However, if the market should choose to drop further and present a valuable buying opportunity, I'm going to deposit another lump sum. But for the time being, I'm going to stick with weekly deposits and just continue to average down on the investments with the highest value. My plan is that as the economy starts to reopen, I'm going to develop my existing positions, and once I think that they have gained their value back, I will look for other positions that haven't quite gained that value back. And if you've enjoyed the video so far, make sure to click the subscribe button, because on Monday at 5, I'm going to show you the companies that I'm buying with an ex-dividend date coming up now. What mistakes have I made with my Freetrade UK app? Well, if you're keen-eyed, and you may have noticed, you may see that I've got less company positions now than I did 1 week ago. And that's because I've altered it. I had something like 15 positions and now I have 12. I eagerly bought into multiple stocks and shares and didn't really research these investments as much as my other companies, and I was just so excited that I bought into them. And these companies were SSE and United Utilities. I really wanted to diversify my utilities sector. I really liked it. I figured if I'm not going to have telecom, I'm going to have my utilities to double up so that it achieves the same effect as telecom whilst not being exposed to that terrible sector at the moment, because otherwise you'd just be losing money. And I really like National Grid because they're a multi-utility company, but they predominantly control the energy, but they don't produce it themselves, which is what I really like. And then their expansion into America provides more value. And I was really just looking for more companies that would fit that and go around it. So I looked at United Utilities that would have water utilities and that would diversify further. Then I thought SSE wasn't a direct energy provider, and I thought that'd be great too. But United Utilities had a payout ratio of 92%, and even though their excellent dividend growth history, I deemed it too unstable, too risky, and very likely to be cut, whilst they had a lower dividend yield of National Grid too. SSE, however, did have a higher dividend yield, and I'm still really on the boat. I'm not sure. I'm happy with National Grid, so I've sold out of those investments and bought the money that I had made from that, or lost, because I did sell at a loss, which is the mistake I did make. I invested too eagerly and I sold at a loss. What I did is, because I sold at a loss, I also bought National Grid whilst it was low, so I sold low and bought low. So that's why you'll see that National Grid has a significant bump up, and for the time being it will be my only utility. At times like this, you really need to plan how much risk you want to have, and at the end of the bull market, say in January, February, you shouldn't be looking to go maximum risk, as at that time there had been an 11-year bull market, and that would have been a great point to buy things like bonds. You want to lower your risk, and then when the market drops, you could then sell out the bonds because they wouldn't have dropped as far, bought equities at a low, and then in the long term made a greater amount of money from it. However, I didn't know that. I just wanted to buy bonds for the same reason, and I didn't achieve that effect because at this point, the market's already so low that they've been priced in. It's unlikely they're going to drop much further, and that bonds will even see that much for demand. And the best way to achieve the most return out of this is going the higher risk. We've already dropped so far, so why not get as high risk as possible so that it can return back up to the top? And that's really it. That's why I've bumped up my financial allocations and then slightly lowered my consumer sector. I've just not been averaging on it at the moment. But the mistake I made with bonds is, firstly, I bought the wrong bond class. I bought the safest bond, which is a gilt, a government-lended treasury, I think. And that was VGov, for instance, which was Vanguard's fund. And the issue was that I wanted something to hedge in my portfolio. So when the market dropped, the bonds perhaps rised. So the stocks went down, bonds went up. I could sell the bonds here and buy more of the shares. But the issue was that this just holds its value, and what I should have done is bought more longer term bonds. But in hindsight, I think I'm gonna wait until we get back into a bull market, and then, for instance, it seems like a recession's coming, you know, the red flags that appear, such as negative yield curves. That's when I'm going to start to look into maybe building up more of a cash position and having about a 20% bond allocation. And then even if there isn't like a recession or a big crash for the next 10 years, at least then I have that in my portfolio to build up, have a consistent income, and then when it does happen, I can slowly cash out of them and buy more equities. So it is a long-term play, and perhaps I might underperform the market from doing it, but that's the risk I want to take. However, the biggest mistake I've made so far was investing in a lifetime ISA. And you may think, well, you did a video on it. Why? You had like a solid amount in that lifetime ISA. Why was it a mistake? Surely you could get a house with that. It depends where you are in the UK. Houses in London, where I live, is extremely expensive. I would have had to have saved in that lifetime ISA for about 10 to 15 years before I could get a substantial deposit for a house. So I've decided that I've changed my ideas and my goals. I still want to get out of where I am currently, but instead I'm not going to invest in a house per se. And if you're interested in what I plan to do leave a comment below, because I could do a video on what my financial plans are for the next 5 to 10 years, and then it would make more sense. But in whole, I didn't want to lock that money away until I retire, and I didn't want to wait 10 to 15 years to get on the property ladder. I transferred my money out and lost about £1,200, but that's okay, because that money was sold at a high, and I bought with that money into this portfolio at a low. So I have actually made substantial returns from it, because that was where my US equities were. I had a large US equity holding in this lifetime ISA, which then I cashed out of once the market had rallied back, whilst the UK market was still down, and then bought back into it. So I actually I want more control over my money, so that in the next 5 to 10 years perhaps, I could withdraw a small amount of my stocks and shares ISA and then use that towards the deposit of what I'm going to buy. And yeah, I've made some silly mistakes, but I haven't made a very, very bad mistake. But I have still learned from these mistakes I've made, and I hope you can too. And I think in every individual's investing journey, we all make mistakes. It's always good to see what others have done so that you don't do it yourself, because learning from others is ultimately such a great way to develop yourself. Next week, in the 8th portfolio update, I'm going to be doing a viewer request and talking about why I'm not invested in US stocks and shares. So click the subscribe button, stay tuned, and click the card at the top right of the video for the 5 high yield dividend stocks I'm buying right now. Thank you for watching. I'm Osborne Foreman. Have an awesome night.